Good morning, everyone, and welcome to our Navigating Growth CEO Insights for SMEs. My name is Joanne Creevy, and I am the Client Services Manager at Kenora Finance and Business Services. I'm joined today by CEO and founder of Kenora, Larissa Feeney. Good morning, Larissa.
Good morning, Joanne. Good morning, everybody.
So Larissa is a fellow chartered accountant, and Larissa is a lead entrepreneur for the Acorns program, as well as a contributor to both the Going for Growth and Ambition programs. Larissa is also a chair of the Donegal County Enterprise Board, a member of the Finance Subcommittee of the A2U, and the president of Donegal Women in Business Network. So as some of you may have noticed, we're kicking off today's webinar with a fresh new look and name. So I'll hand you over to Larissa to give a little overview of our exciting new rebrand to Kenora.
Thank you, Joanne, and welcome again to everybody here. So as Joanne said, you might have noticed our new name is Kenora. So we branded from Accountant Online in May to Kenora Finance and Business Services. And the reason why we did that was because over the past few months, indeed the past several months, I would say 18 months or 24 months, we've been reflecting on our mission, our values, and how we can better serve our clients. And after careful consideration, we realized that it was time for a change, and we got feedback from clients, from our team, from various different stakeholders like our board, for example. And then we started a process of a rebranding, and we came up with the name Kenora. It was a name that was suggested by one of the team. But nothing else has changed. We're still the same and 100% dedicated to you and the growth of your business. Okay, Joanne, will we kick off then?
Yeah, so I suppose just to give a little overview about Kenora. So we are a firm of chartered and certified accountants, as well as company secretarials, supporting businesses with their compliance, payroll, secretarial, bookkeeping, and tax needs. We are an award-winning practice, most recently recognised by Xero as Partner of the Year for the 4th year in a row. We were also awarded Online Practice of the Year and Client Services Award at the 2024 Irish Accountancy Awards. So we offer transparent fixed monthly pricing. Technology and digital processes are at the core of our operations. We aim to streamline your accounting tasks, making them more efficient and hassle-free for you. So we are experts at providing support at every stage of business, from managing statutory accounting requirements to providing financial and business services like bookkeeping, payroll, and company secretarial. We're here to ensure your finance operations run smoothly. And over the years, we've carefully assembled a multidisciplinary team of professionals with specializes areas in including corporate and personal taxation, corporate finance, financial management, information technology, marketing, and company secretary. So Kenora is a full suite of finance and business practice, and as we've grown, our range of services have grown with us, reflecting the various needs of a wide and ever-growing list of clients. So today's format, this morning's webinar is ideal for SME owners and managers and established entrepreneurs, considering the services of a chartered accountant, bookkeeper, or payroll provider. So it's important to note that the information contained in this webinar is for general information purposes only. For specific advice related to your business, you should always consult directly with an accountant. And if you do not have an accountant, we'd be happy to support you. I would like to encourage your participation during the webinar, so please utilise the Q&A or chat function to ask questions you may have for Larissa throughout the session. So the agenda looks like we will begin with a brief overview of 4 key areas crucial for business growth: hiring employees, financing, profitability, and compliance. We'll introduce strategies to effectively navigate these areas as you expand your business, and you'll learn essential steps to ensure sustainable growth for your business. And finally, we'll discuss the importance of partnering with a professional to support your growth journey. So over to you, Larissa.
Super. Thank you, Joanne. Okay, so as Joanne has said, this is a Q&A. So really what we've tried to do is answer questions that were asked quite a lot in Kenora. And really, I'm here, I suppose, to give high-level answers to the questions and to give a little bit of insight into maybe what we've seen or what I've seen over the last few years in terms of how businesses have approached these issues. It is a really great opportunity for you to ask any questions. So please do utilize the chat function, ask any questions. The questions that you ask don't have to be related, of course, to the topics that we talk about. There have been some questions that have been submitted already, and Joanne will ask those through the next hour or so. But if anything at all comes to mind, please do ask it. I'm more than willing to answer any questions, and I'll absolutely come back to you if I can't answer it live on the webinar. Okay, so kicking off with operational growth then and hiring employees for long-term success. So really this is, I suppose, the cliche almost, isn't it? That you're only as good as the people on your team, and you should always hire people that are better than you. That type of thing. And really, it's a cliche for a reason. It's because it's in the main, if you look around it, large successful businesses, they are run by highly effective and productive teams, and they're led by highly effective individuals. For small business, though, it is the timing of the hiring decisions that's very important, because if you're making a decision to hire either your first employee or your 100th employee, you have to have the cash flow and the cushion in order to make payments to them before they become productive. So it's understanding when is the right time to hire based on workload, revenue projections, and overall business objectives. Because if you decide to make a hire, the hire can either be a revenue generation role or non-revenue generation role. And if it's a revenue generation role, it sometimes can be easier to make the decision to hire, because that person can generate revenue for the business relatively quickly, right? Work can be delegated to them. They may need to be trained up, but they can start being productive relatively quickly. It is a harder decision if it's a non-revenue generation role, because that means that the revenue generation individuals on the team have to carry that cost. So there has to be a very strategic decision made in terms of what work that person's going to do and how they're going to free up others in order to make them more productive. So decisions like that is where small business in particular have challenges. So really it is about looking forward, looking at your revenue projections, what it is you expect to achieve. And more importantly, and this goes on regardless of how many employees you have, if you're employing somebody, you would expect your revenue to increase as a result of that employment. Unless your team are perhaps overstretched in the first place, that's another issue. Generally speaking, you should expect your revenue to go up or your profit to go up. Otherwise, why would you do it?
And Larissa, what are key challenges businesses encounter as they scale their workforce, and how can they effectively navigate these challenges?
I know we're going to talk about finances later anyway, Joanne, but that is one of the main challenges that small and medium-sized businesses would face, is making sure that they have the cash flow, or making sure that the individual becomes productive as quickly as possible. And I would often get asked the question, how much revenue should an individual employee generate for a business, as a rule of thumb. So understanding what that is, if you're paying an employee 30,000 or 40,000 or 50,000, whatever the case may be, what do you expect the employee to generate in terms of revenue as a result? Now, that can go either for revenue generation roles or for non-revenue generation roles. It doesn't really matter. They're just for non-generation roles, the revenue is generated in a different way, of course. It's either through cost savings in another way or through making other people more productive. That's the main challenge. Other challenges include finding the people, because in today's environment, in Ireland, we're operating at almost full employment. Employees have more choice than they ever had before. And how do you as an employer stand out? And how do you make your role attractive whenever you're competing against many, many others in the marketplace? And how do you make sure that you get the best potential talent? And that's difficult, and it's very difficult for small business to set themselves apart from their competitors whenever they're competing for talent. And that's done. We see that in various ways. It's obviously salary. That's one way. But salary is a market rate. And by the way, if you are wondering, you know, how much in terms of a salary you should pay your team. There's loads of objective information out there online that will help you figure out what's the right rate and what you should be paying, you know, comparing yourselves to either your competitors or businesses of similar sizes in different industries. You know, if you're employing a generic role like marketing or finance, for example, you can compare yourself that way. There's loads of data to help you to understand what you should be paying. And then trying to differentiate yourself in other ways. I mean, the remote working, the flexible working, working from home, that's all very topical at the moment. And indeed, I've seen data recently that suggested that 70% of potential employees won't even look at a role if remote working is not offered as an opportunity, or a hybrid offering is not possible for the employee. So I thought that was interesting. It's very difficult if you don't offer a hybrid approach to be attractive to an employee. And the reality of today's environment is that employees do have more choice than they ever had in terms of the employer that they want to work for. And COVID has allowed the employee to have a very strong voice around where they do their work. Because if productivity isn't affected, then it's very, very hard for an employer to force people back into the office. Employers will talk about culture, of course, and you know, collaboration and relationship building. But from the employee's perspective, it suits many lives and work-life balances to allow people to work from home.
Thank you, Larissa. And there's just a little action list then.
Okay, so these are some ideas really in terms of what you can do if you're considering employing for the first time, or if you're considering looking at increasing your workforce. The first one is proactive workplace planning. So we would do this a lot in Kenora, and that's around how many people do you need if you have a certain amount of revenue in place, and where are those people going to come from? Where are they located? How much are they going to cost in terms of salary? How much are they going to cost in terms of recruitment costs? Do they need to be located in a specific geographical area? If not, where can they be located? Are there any type of legislation issues or legal issues around employing in different countries for your organization? And what does that look like? So that workforce planning, if you were to look out 24 months, 36 months, or 5 years into the future, what do you need in order to meet your revenue goals and objectives? How fast is the business growing? And where are those teams going to be located? Revenue projections and cash flow is an obvious one. I've already mentioned it. You know, at a basic level, you know, and you will hear if you listen to entrepreneurs and business owners who have scaled very quickly, they'll all talk about the pain of salaries, the pain of making payday, of not having the cash. And that's because it's, you know, you obviously have to have your team and you have to have the capacity there to deal with the revenue expectations as they come in. But that means bearing that cost up front before the employees become fully productive, or indeed the revenue is fully maximized. So making sure that you have a cushion to allow you to make those payments. Now that could come by having revenue projections and cash flow projections in place. You should have a fair idea. You're not going to be 100% accurate, but you should have a fair idea on what your business needs are. And if having done that, you have identified that there is a gap, so there's a deficit in terms of cash, and in the early years of growth, that can be very difficult. The question then is, how do you bridge that gap? And the time to address that is in advance. Whenever you have identified a gap, is going out to understand, okay, how can you address it? And we'll come to funding in a moment, and there's various different ways that you can bridge that gap with different types of funding. Okay, hiring needs and anticipated business growth. This is a really hard one to get right. You know, I've always felt over the last few years growing this business that, you know, if you could figure that out, it would be fantastic, because whenever you go to hire somebody, generally speaking, as SMEs, we hire when we need. We don't hire in advance of the need, because we're very busy or we underestimate the amount of time that it takes to hire. And then by the time you actually have somebody in place and trained up and fully functioning, it's 6 months later than when it should have happened. So ideally, your person that you're hiring needs to be fully operational and fully productive when you need them, not after you need them. Otherwise, you risk the wheels falling off the bus completely. and other employees carrying that load, which can be very difficult. And it can mean that you risk losing perhaps people that have been with you a long time because you're asking too much of them. So definitely understanding when you need somebody and hiring in advance of that need. And that means hiring more than likely starting that process 3 or 4 months in advance. And even if you look at in other areas of your business, whenever you're employing, for example, even if you have a fully functioning team, and you have a maternity leave or a paternity leave coming up, the same things applies. It's hiring in advance. Now that does mean a cost to the business, because if you're hiring in advance of a need, you are suffering that cost and absorbing that cost for that 3 or 4 months or whatever it takes. And that can be difficult if your margins are very tight, which is the main reason why a lot of SMEs don't do it. Apart from being busy, and that is a valid reason, of course, but it is very difficult to absorb that cost if margins are very low. And it really has to be built into your projections, because you have to have that cushion for allowing for additional hires if as you're trying to grow your business. Now, this also applies, I've already mentioned maternity leave, but it also applies in areas like sick leave, for example. I mean, if you are losing somebody because they're sick and you need to replace them, you have an obligation to pay that person who is sick for a period of time. And that period of time is increasing from now on as well, of course. So it's about making sure that that cushion is built into your revenue generation targets to allow you to do that. Okay, leveraging technology and partnering with professionals that help streamline operations and mitigate risks. So I'll talk about this a little bit more in a moment as well, because this is very much about using technology to allow you to be as profitable as you possibly can, so that your employees are adding value to the business rather than doing tasks, non-value add tasks, let's call them. So tasks that can be automated. If you have people that are performing tasks that can be automated, then that means you're probably paying too much and your margin is probably too small. And we talk about this with clients all the time, where whenever we go into a team, we try to identify, okay, what can we automate here? What roles and what tasks can we replace with technology? Now, and it's not resulting in anybody losing their jobs or a reduction in the workforce. It's freeing up those skilled individuals to add value to the organization.
Larissa, I'm interested in understanding what contributes to long-term success when it comes to hiring. Are there specific practices or strategies you recommend for small business to ensure their growth is sustainable and aligns with their overall objectives?
Oh, yeah, that's a great question. There's a lot. I mean, I can tell you from experience that small businesses, whenever you hire, I know I certainly had a tendency to hire people that I liked and people that I got on with in interviews, and people that I felt I could talk easily to in interviews. And that's not the right strategy at all, of course. And I mean, I've learned that over the years, that you have more chance of success. Now, what I should say is that hiring is not always successful for various different reasons. In fact, a recent statistic stated that 70% of senior hires are not successful. So that will give some indication onto how hard it is and how difficult it is to actually get the right people. And add that to the environment that we're currently operating in, where there is a lot more jobs than there are individuals, and it makes it harder still. So the employer should bear that in mind, that it's very, very difficult to get the right person. So don't beat yourself up if the first couple of hires don't turn out to be right for you. What I would say would really helps in these situations is structure. Having a structure around the hiring process, having more than one interview. So whether that's 3 interviews or 2 interviews and a presentation, whatever it might be, having a very clear job description and matching that job description to the skills that the candidates have. And then objective interviews is really, really important, because we all have bias. We generally like people who look like us and we like people who talk like us. That's very natural. And as an employer, we need to step back from that. And to help us to do that, it's really good to have somebody else on the interview process with you, especially if you're on your own in your business, or even if you do have a HR person, the two of you working together to identify the right skills that's needed is important. And the big thing, and such an obvious thing, the big thing is references. Whenever you talk to other employers of the individual, and you wouldn't believe, Joanne, the amount of small businesses that hire but don't check references,
Yeah.
because they're going on face value. And in interview, we always put our best forward, don't we? That's all we see as the best. So checking out references, more than one reference, is really, really important.
Thank you for that, Larissa. And on to our next topic. Larissa, how can we use budgeting to align our financial planning with our overall business objectives?
Okay, so the big question that we're asked all the time is around funding. Is how do I mentioned a funding gap earlier on whenever I was
Yeah.
talking about employees? Um, how do you fund the growth of your business?
Yeah.
That's the question. So there's various different ways of funding the growth of your business. Depending on the industry you're in, depending on the stage of business you're at, it really depends on what's right for you. If I start from the beginning, I suppose, if I start with a startup business, and I know we've got both startups and larger businesses on the call, so I want to cover both.
Yeah.
But essentially, there's two different ways, two different methods of funding. There's debt or equity. So debt, for those of you that don't know, is essentially a loan in some form. So the business getting a loan from some organization to help fund growth. It could even be a loan from you in many cases, it could be a director's loan or equity. And equity is essentially giving an organization or an individual a share of your business. And that's essentially the difference between the two. Now, you might have heard the term bootstrapping. Bootstrapping is when a startup business funds growth by themselves. So, in other words, if the business is generating any type of profit, this particularly applies to service businesses, because if I give you the example of Kenora, whenever we started, we were able to sell services, and we were able to do that at the start with no capital outlay or very little capital outlay. Then we were able to use the profit to reinvest and to continue to grow that way at the beginning before we got investment. And that's the way many businesses start. Challenge with bootstrapping is that it can be very slow, because depending on the margin that you make on the product, or if you're the type of business that doesn't make money in the beginning, which is very common if you're developing a product, or you're researching a product, for example, there's a lot of time that's needed, and there's a lot of outlay, and somebody needs to fund that. So that's where bootstrapping sometimes doesn't work. Now, if bootstrapping is applicable, and I mean, sometimes whenever I have these conversations, there's a choice between the two. You can bootstrap your business, or you can go and look for alternative sources of funding. If you bootstrap it, you have to align it to your business goals. So bootstrapping is great. You're keeping all the equity for yourself. You might be growing slowly, which is maybe what you want. But if you want to grow quickly, then bootstrapping is probably not possible, because you do need the injection of cash in order to build up your team and build up your product, or get your product fit to market. So bootstrapping may not be applicable. So it's almost about having the conversation with your advisors to understand what it is you want to do, and then what are your options for getting there, and making a decision on that. If, again, sticking with startups for a moment, if bootstrapping is not an option, or you don't want to do it, the other option then is obviously grants. I mean, that's the big one. And this applies for whether you're a startup or a scale-up business. You should be exhausting any of the grant options that you have. So whether that's local enterprise office or EI, or if you're cross-border into Trade Ireland, or whatever, you should be exhausting all the possibilities there. That can be difficult because it's quite time consuming. And what I have found over the years is small businesses would say to us, I don't have the time to apply for grants. They make us jump through so many hoops, and they do. And they have to, because it's taxpayers' money. So of course they have to make sure that it's well spent. But it is definitely worth investing the time to make, because it's cheap funding. They're not looking for it back in any way, generally speaking. So do absolutely exhaust that option. And then if you have exhausted the option and you don't want to bootstrap, Traditional loans is probably usually not an option for startups. Not always the case, but it can be very difficult to get a traditional loan from a traditional bank if you have no trading history, no profit, no security. So this is where equity comes into play, and whether it's angel investors, crowdfunding, or venture capital, all of those would come under the equity umbrella, and they would all be interested in investing in startups. Angels tend to be the first investors in a business, and they would come in as what's called a seed round. Angels would be high risk investors. It could be friends and family of the business owners. That's sometimes what you find, because they're backing the founder. And venture capital crowdfunding also comes in earlier, and venture capital comes in a bit later. Now, if your business is a little bit more mature, has a track record of generating revenue and generating profit, then traditional loans are a viable option for you. So the big difference is traditional loans in general. So I'm talking about term loans from finance organizations, whether they be banks or something similar. Now, the big attraction for businesses is the interest rate, because giving away equity can be expensive. It's also a bit risky because you are, sharing your business, and you need to be careful who you're sharing your business with. And that relationship is very important. And if it goes wrong, that could be very difficult. Traditional loans with a bank or similar, it's a very different type of relationship, of course, but it's cheaper funding in general. It's very clear what the interest rate is. And it's a very, very clear transaction. So for the larger or the more mature business, I always find that loans are, well, a lot of businesses don't want to go for loans because they think that equity might be better for them. But actually, equity can be quite expensive. And sometimes a loan is a better option. So definitely something to consider. Now, another. Whenever I say traditional loans, I mean loans for banks, but also like corporate finance, those types of facilities as well, invoice discounting, things like that, where it's not giving away equity, it is debt, and it depends on your business, it depends on the industry you're in, it depends on your balance sheet, and various other characteristics of your business as well. But definitely important to consider, and not to discount it as not a viable option, especially if your business is more mature.
Thank you, Larissa. Larissa, why is it crucial for businesses to have a deep understanding of their financial metrics, including management accounts, cash flow forecasting and budgeting, and how can this knowledge empower strategic decision making and ensure long-term financial stability?
Okay, so I mean, as an accountant, I am going to say that the numbers are the most important part of your business. I am going to say that. Now, if there's any marketing professionals on the call, and I think there may be going from
Yeah.
the registrations, a marketing professional will always argue with me that, the marketing is the most important part of the business. And I do agree with that as well. So it's very hard to argue with that logic. However, numbers are really, really important, of course. And any profitable, successful business has a foundation of strong numbers. Because without strong numbers, it's just not possible. You may last for so long, but it's not possible to grow a business over the long term without having those strong numbers in place. I've never seen it happen, and it isn't possible. Now, it's not necessary for the founder or the business owner or the CEO to have a strong background in numbers. I don't believe that it is, because it's not possible for a business owner to be strong across all areas. No, none of us are strong across all areas, but it is important to recognize that that area has to be invested in, just like any other part of the business. So whether that's you doing it if you're a very small business owner, or you have a team, and you have those experts around you, it's absolutely fine whether you outsource it or you have an internal team or you do it yourself. Whatever the case might be, as long as you've made a decision that's right for your business and the stage that it's at. I mean, at a very basic level, we're looking at statutory accounts, which is looking back at the year just gone, and we have to do that as business owners, obviously, whenever we're filing our accounts and paying our taxes. But that's not the important part of your numbers from a running your business perspective and a looking forward perspective. That's where management accounts, cash flow forecasting, and budgeting comes to play. So as you grow, as your business grows, that looking ahead over the next 12 months, 24 months, 36 months, knowing what's going to happen if revenue goes up, if revenue goes down, knowing the impact on the cost, the impact on your margins. None of us have a crystal ball, right? So none of us is going to know exactly what our revenue is going to be over the next 12 months. It's not possible because stuff happens and you might be knocked sideways and you might have to pivot and all of that stuff. But it's to help guide you along the road so that if you know that numbers are going one way or the other, that you know the decisions you have to make. It's absolutely crucial. It's also, it's also vital that you compare what's actually happening to what you thought was going to happen so that you can understand. This is where management accounts come in. This allows you to understand what decisions you have to make as a result and why it's happened. So why has revenue fallen? Why has revenue increased? And was it because of, increased marketing activity, increased production or productivity from the team, whatever it might be. But it's understanding and having discussions around those reasons, which will help you to grow your business and to make better decisions going forward.
Thank you, Larissa. And just over to the action list.
Okay, so evaluating each type of funding based on where you're at is really important. Taking advice on that. I spoke to a business owner last week who who just thought that he was going to bootstrap his business, so that was the right thing for him. And after having a conversation with him, he thought, well, do you know what? Maybe that's not going to get me where I need to be in the time I need to be there. So I need to accelerate that growth. And how am I going to do that? Because it's not going to happen with bootstrapping. It's just having those conversations with your advisors to understand what's right for you and what's right for the stage that your business is at. And I mean, back to the debt issue for a moment, the cost of that funding is really important. So if you can get cheaper funding, then why wouldn't you? Would be the question I would ask. Okay. The comprehensive analysis of your financial position, depending again on where you're at in your business and the stage that you're at, what do you have to what should you be looking at in terms of your numbers? And there's such a varied level here, because if you're starting off, you may have very straightforward requirements from a reporting perspective. If you're a more established, larger business, then you will have requirements, certainly for monthly management accounts, probably for monthly KPIs, which are key performance indicators across the various aspects of your business. I mean, ideally, if you're a CEO of, a mid-sized business or an MD of a mid-sized business, you're really looking to get a pack on a monthly basis that will give you breakdown of the key areas of your business and the KPIs for each of those areas, so that you can understand what's happening. So you're not constantly asking questions as they come to mind of your team, that information has been delivered to you, ideally in real time, but certainly within the first week or 10 days of the following month.
And I suppose we at Kenora can assist with creating budget forecasts aligned with your business objectives. So helping businesses understand their financial implications of workforce scaling. And I suppose just as a reminder, if you have any questions regarding any of the topics, do put them into either the chat or the Q&A. Larissa will be happy to answer those questions. So just on to our next topic. So Larissa, how does a well-defined pricing strategy contribute to the success of a business, considering approaches such as cost plus, value-based and time-based pricing? And can you provide examples of how each strategy can impact profitability and client satisfaction?
Yeah, thank you, Joanne. So pricing is a topic that comes up all the time, especially for service businesses. For businesses that sell products, it's much easier to price. It's not an exact science, of course, but if you're selling a product, you have a much better idea of the cost of the product. If you're selling services, there's a little bit more of a calculation to do, and that can be a bit more difficult. So understanding your cost is the first place to start, whether you're selling products or services, understanding exactly how much it's costing you to produce and or deliver that product or service to your client or customer. That's where you start. I know there's a couple of people here who are consultants. So you may be working by yourself on your own. valuing your time is where I see the biggest challenges there for that type of business. So understanding what the cost of delivering is for you for your business is important. And after that, then there's various different strategies in terms of pricing. The first one there is cost plus, which is basically, as it says, so it's taking the cost of producing the product or the service and it's adding on a margin to it, come up with the selling price. So you might, for example, produce for 50 and sell for 100. So you're adding on 50, you're adding on 100%. So in that case, it's cost plus 100%. So it's working out what the margin is that you want to achieve. The next one there. Now, the thing about cost plus, first of all, is it's very straightforward. It's very easy to calculate. However, the margin that you want to get may not be the margin that is possible on the market. And this is where you have to keep one eye on competitor-based pricing. Like competitor-based pricing isn't listed there, but it is another method of pricing. And even if you don't price based on competitors, you should definitely keep one eye on competitors. And we don't want to be dictated to in any way by our competitors, but you do want to stay ahead of competitors. So you need to know what's going on in the market. So understanding what margin is possible by keeping one eye on the market and then adding on whatever that margin is to your cost is a very simple way of coming up with your pricing strategy. The next one is value-based, and value-based pricing is one that's used extensively in services, in professional services. So that's based on the value that you're giving to your customer or client. So it's not about your time, it's not about your cost, it's about the value that you're delivering. It's a really, really difficult one because it's different for everybody. The value that you're giving to me might be different than the value that you're giving to somebody else. So it's a very individual approach. So it works best for service businesses, for professional services, and for consultants. For those types of businesses, it works well for. And it's actually a very successful strategy if you do it well. There can be high margins in this strategy. The only challenge I find with it is that it's difficult to scale because value-based pricing tends to be based on your judgment of the value that you bring to your customer or client. So if you pass that responsibility over to somebody else as you grow your business, then it's their judgment of the value that they're bringing or you're bringing to your customer or client, and they may come to a decision that you're not happy with. So it's a difficult one to scale, but very, very good one if you're working by yourself or in a small team. Time-based is very straightforward. That's basically based on the time it takes to produce the product or service. This is one that's also used a lot in services. And it is essentially you're pushing an hourly rate on your time. Now, it's a very straightforward method, but it does mean that you are tied to time and you may not want to be tied to time. You may be the type of business that wants to sell based on the output or sell based on value. Because if you sell based on time, if you're really, really efficient or really, really productive, or you automate some of your processes, then it's going to take you less time. But does that mean you're giving less value? That's a difficult one. And I think that depends on business to business. Also, if you were paying for a time-based service, would you be happy to pay more if it happened to take an individual longer to do it because they happen to be slower or training or newer in the job or whatever it might be? And I don't think as a customer that I would be happy to pay more. And then if I'm not happy to pay more, does that strategy work? I have question marks over that. The other one I mentioned was competitive based pricing, which is also very popular and definitely should be used as a yardstick. And then there's other ones like penetrative pricing, where essentially you price lower in the market to get traction and then you slowly increase your price over time. And this is a really popular one if you think of supermarkets or new brands or introductory offers, things like that. That's all penetrative pricing because you're trying to get known in the marketplace, you're trying to gain traction and you're trying to grow. And the only way that you can differentiate yourself with certain products, and this tends to be a product-based strategy, the only way you can differentiate yourself is by lowering the price and then trying to increase it over time. The other method that we sometimes talk about is price skimming. And that's essentially where you're skimming over the top of the market. So you're actually at the higher end and you're selling your services or your products for more. What strategy you adopt, it doesn't matter. It only matters that you're intentional about the strategy that you adopt so that you know what you're doing and why you're doing it. What I have found, especially whenever I've presented in workshops to services businesses, is that there's no strategy there around how much they're charging. It's just what they think is right. And once you go deep on the numbers, you realize that the margin is actually quite small. So there is a confidence element here as well. It's having the confidence to price correctly or price what you're worth. Okay, Joanne, moving on to the next point there around, around payment terms.
Yeah, so I suppose how does payment terms play a crucial role in ensuring timely payments for businesses, and what strategies can businesses implement to optimize payment terms and improve cash flow management?
Okay, so see, whenever I talked about funding earlier on in
Yeah.
the hour, we talked about different ways of funding the business. Whenever looking at the bootstrapping area again, one of the major ways around funding is making sure you get paid on time. Because if you have money, if you're in the type of business, and this isn't all businesses, but if you are in the type of businesses that where you're expected to give credit to your clients or your customers, then that means that you have to fund that. So for a period of time, and it's very industry specific. Some industries, it's normal to pay up front. Some industries, it's normal to wait 30 days, 60 days, 90 days. Now, this has gotten massively better in the last number of years, I will say. Some industries are still quite bad. But I do think with the new businesses that are starting up, new businesses are very strict about payment terms. And so I'm hoping this will start to change. If you run a business where you are expected to give credit, then you have to be very clear around the credit terms that you're providing and the cost of that credit to your business, and making sure that you have a team or person or somebody responsible for getting that money in on time, whether that is 30 days or 15 days or whatever it is. And do this, there's a confidence element here as well, because you in your business, you have the power to set the terms that suits you. You may risk losing business, and that's, that may not be a price that you're willing to pay. It's just about understanding what the cost is. Oh, I think we've lost Joanne. I'm just going to share my screen, guys. If you just bear with me a moment. I'm just going to share my screen, and then I can pick up from where Joanne left off. Oh, Joanne, you're back. Do you want to share your screen again? I was
Oh,
just sharing.
sorry about that. I must have lost signal there. I'll share screen here again.
Okay, super. Technology.
Yeah.
Okay, so where was I? Yeah, so if you are giving credit out, as long as you have a structure and a team, and a process around collecting that money, like, I can tell you about conversations with business owners where I've asked, how much are you owed in? And everything's in the head rather than, on a system. And that's really difficult. So having a very simple process around credit terms and the people who owe your aged receivables or your debtors, so the people who owe you money, and understanding the cost. Now, what I should say whenever I talk about funding again is if you are in the type of business that does give credit, and it's normal in many, many industries to do that, then there is a method of funding available called invoice discounting, where you can get funding for a certain percentage of that invoicing, and you can get that up front. So rather than having to wait 60 days or 30 days, if you have cash flow issues, and it is a working capital requirement, which means that you need that money in just to operate day to day, then that invoice discounting facility can be an option to allow you to get funding to trade while you wait for your clients or your customers to pay you.
And on to the action list.
Okay, so cost analysis is really important, knowing what your direct and indirect costs are. So your direct costs are costs that are attributable to your sale. So for example, if you are selling candles, your direct cost is the cost of buying in that candle or the cost of making that candle. So it's very, very clear what your direct costs are. You couldn't get the sale without that cost, is another way to describe it. It could even be transport costs, the cost of bringing your product from your warehouse to the delivery point, or to the customer. They are all direct costs. Indirect costs are everything else. So indirect costs are costs that you have to incur to run your business, like utilities, light and heat, perhaps, administrative expenses, insurance, but they're not critical to the sale. So in other words, you can get the sale without light and heat, for example, in the office. But you need the light and heat in the office to run the business, or certainly to grow the business. So that's the difference between the two. So it's knowing what they are, understanding what's normal for your business. So the proportion of the direct cost to your sale, that percentage is really important. And it's knowing what that is, what's normal for your industry. And there's loads of information, by the way, on that online. If you look it up, you can identify what the right margin is for your industry and even for your stage of business. Payment terms, if you are, as I've already said, if you are in the industry where you have to give credit, it's understanding what credit you're giving, why you're giving that credit. Do you expect a deposit up front, for example? That can be a great way to get some money in. Do you expect, payments on account at different stages of a project if it's a long-term project? And if the project is complete, when do you expect payment by? Or do you expect payment before the project is complete? So all of those questions, the answers will vary depending on your business. And finally, using software to automate invoicing and chasing is really important. And there's loads of software out on the market. Xero is one of them. And there's, if you are in the business of giving credit, there is an add-on to Xero called Chaser, which will allow you to, chase money as such. And it will automatically send out in statements and invoices to your clients and customers. And don't be afraid to ask for money. I see this all the time as well, where business owners will be almost a little bit nervous about calling for money or contacting a customer for money, because you don't want to damage the relationship, of course, with the customer. And that's very admirable, and it happens all the time. And sometimes what I've seen businesses do to get around that is to outsource that, to genuinely outsource it, or in some cases I've seen like a second email address, collections at whatever, to allow the business owner to take a step back from collecting and to preserve the relationship with the customer, if that's a concern.
Larissa, we have a question here. So as a service-based business, we struggle with setting prices that truly reflect the value we provide. Can you share some insights or examples of how businesses can effectively use value-based pricing to ensure their services are valued correctly by clients?
That's a great question. And this is so normal. I mean, even recognizing the fact that you struggle to set pricing whenever your service business is really good. The challenge with value-based pricing is that there's no right or wrong. And I can't give an answer to that, only to say that if you test the market. So when we talk about value-based pricing, we're talking about communicating the value that we're bringing to our client. So I don't know what this person does or what the company does, but say, for example, if we talk about our own, Joanne, because it's easy, it's easier to talk about our own. So whenever we talk about from Knorr's perspective, if we're bringing the value that we might bring to a client might be around reassurance that the accounts are taken care of, that the compliance is taken care of, that I remember a client saying, "You make us feel safe." So in other words, we're the regulatory element is taken care of. So that it's communicating that value in a way that your client understands, and trying to understand what it is that your client values. And that differs, of course. So for our clients, it could be that safety, and it could be the compliance, it could be the day-to-day bookkeeping that that we do that correctly. It really depends. And this is where it gets very difficult. So talking with your clients or your customers to understand what it is that they value, I think is really important. And then trying to sell your services based on that value. But also crucially understanding that every client is not your right client, because they mightn't value the services that you're providing them with. And that's also okay, because you can't sell to everybody. So you might find that you're getting negative feedback from a client around pricing. That doesn't automatically mean that your pricing is wrong. It may mean that they're not the right client for you. So whenever we talk about value-based pricing, the value is really important, but equally important is understanding what your cost is. So you have to, now depending on the size of people that are in your team, you have to look at the cost of the labor. You have to look at the cost of running your business. So at least you can establish a floor under which you're not willing to go in terms of pricing. And then you can build on it in terms of adding on margin to that figure, whatever that figure is. So unfortunately, there's no black and white. This is the challenge with value-based pricing. Confidence does come into it an awful lot, but crucially understanding your clients and understanding what their value is where the key is to unlocking that challenge.
Thank you. I hope that is helpful. And Larissa, so what are the key compliance requirements for businesses, and how can businesses assure they can stay compliant while effectively managing their operations?
Okay, so for compliance, and this tends to be a challenge for startup businesses, because usually as a business grows or when a business grows and scales, the compliance requirements are taken care of as a matter of course. So what we find is that when a business is in the early stages of growth, compliance is a real headache, because there's that perhaps it's just a lack of understanding what the requirements are, certainly a lack of experience, perhaps in dealing with accountants or other professional advisors, and certainly a lack of experience in dealing with revenue commissioners. And revenue commissioners can be, they can be quite, I suppose, scary for
Yeah.
many people. So if you're in the early years of your business, then compliance is really, really important. Understanding when your tax filing deadlines are, understanding when your financial reporting obligations are. I always say that you cannot outsource the responsibility in this area. You can outsource the task, which is what most businesses do, to accountants and others, but it's still your responsibility as a director or a CEO of a business to make sure that it's done. That's very difficult because it's one of these areas where most business owners aren't comfortable in. They're a little bit worried about it, they're a little bit afraid of it, but it's still a responsibility and it comes with the package of running a business. So always make sure that you have your main tax deadlines and your CRO filing deadlines in your calendar for the next 12 months. They don't change. There's no reason why they're not in your calendar. And then you know what's coming and nothing is a surprise. Nothing should be a surprise in this area. And this is another thing we hear all the time is, I don't want to get any surprises. There shouldn't be any surprises because these don't change. And it is your responsibility as a business owner to know when they are, and make sure they're in your calendar. That's the best advice that I can give, Joanne.
Great. And what are the potential consequences of non-compliance for businesses, and how can proactive compliance measures prevent these risks?
Well, at its most severe, I mean, it gets very severe. If any of you have read the media over there, the papers over the last couple of weeks, you would have seen that revenue commissioners have published their recent default list, and you'll see a list of taxpayers throughout the country who came to a settlement with revenue. And I mean, I think the highest was almost 1 million. So it gets quite severe. It can, of course, lead to issues around reputational damage, penalties, absolutely, and fines, all of that. So it is quite difficult. The hardest part of our system in this country, and it's a similar system throughout the developed world, is the fact that it's a self-assessment system. So nobody comes and tells you, nobody checks on you. It's your responsibility to make sure you file on time. It's your responsibility to make sure that your accounts and your tax returns are correct. Yes, you can outsource to professional agents who can help you and assist you in that, but it is your responsibility to make sure that they are completed. So if you don't do it, or if you find yourself in a situation where you were late, then that can be quite difficult, and it can be quite difficult to manage because you're also trying to run business. So I would always advise you to stay ahead, make sure you know what's coming. That's why the advice around putting the dates in the calendar, and make sure that you have good, skilled, professional companies, organizations, or people taking care of this side of the business for you, because the consequence of non-compliance is such that you don't want to be that person. You don't want to be sitting in front of an auditor and not being able to answer the questions. I always say, Joanne, if I had my way, businesses would be audited very early on in the business journey, because I do feel that it's such a stressful thing to have to go through, especially if things aren't correct, that, you know, if you do it early, then you know you have a much better idea of what you need to do. And those established businesses on the call, we might even have a couple who have gone through a revenue audit already, and they'll be able to speak to how stressful it can be. And that's when everything's been done correctly. So you can imagine how stressful it can be if things aren't done correctly.
Yeah. And I suppose if any of the businesses on here are seeking some support with your compliance requirements, do you feel free to reach out after the webinar? Our client services team are ready to provide a customized proposal tailored to your business needs. So I'll provide our contact details as well at the end. I suppose just another question here, Larissa, as our business continues to grow, we want to be proactive about compliance. Can you share some strategies for staying ahead of compliance requirements and avoiding last minute scrambles or oversights?
Yeah, absolutely. So I've already said about putting your dates in the calendar. What I would say is that you are generally working with a partner in this area. So generally speaking, you're working with a bookkeeper, with an accountant, or with a tax advisor of some description. That might vary depending on the stage of business that you're at. Remember your responsibility on managing these partners that you're working with. So if I give you an example, let's say you've operated for 12 months, or let's say your year end is the 31st of December. When do you expect your accounts to be completed by? When do you expect to know what your tax bill is? What we find is that businesses tend to wait for us to request books and records from them. So in other words, whenever we request them, they send them in to us and we start working on them and send them back. That responsibility, or the power, I suppose, in that relationship should fall on the client, on the business owner. The business owner should demand when they want their accounts completed by. So for example, if your tax is due in September, you really want to know what your tax is, what, in April, May, or June time. So you have time to prepare. You don't want to be finding out what your tax bill is in September. The same applies for, we talked already about budgets and cash flows. It's understanding, okay, do I need these financial statements? Does your business need monthly profit and loss? And then making sure that you're partnering with an organization that can provide them to you in a timeline that works for you. And remember that if you're not getting the service or the speed that you need in terms of the information coming to your business to help you to make those business decisions, make sure you have the conversation so that those expectations can be reset. It is about a two-way communication strategy, I always think, whenever we're working with advisors, because from sitting from this side, whenever we're dealing with our clients, we don't necessarily know what it is that your business needs or wants until we have that conversation. We can advise, but things change quite quickly in businesses, especially as businesses are growing. We've had cases where, for example, boards of directors might have been appointed and they have different requirements, and we need to make sure to keep on top of that.
Great.
Okay, from an action perspective then, the calendar, I've already mentioned that. Outsourcing compliance tasks, I've mentioned that already. I mean, that goes without saying. If you're investing in an accountancy firm or bookkeeping firm or tax advice, make sure that they're qualified, that they're insured, that they're regulated. Check out the reviews, speak to people who work with them. That can help give you a steer on whether they're the right partners for you. And remember that it is a relationship as well. So it is about finding the right relationship. And, accounting software, it goes without saying in this day and age, unless you're a really, really small business, most businesses will benefit from some type of accounting software, even the most basic packages, to make sure that everything is automated, that you're removing manual entry as much as possible, and you're seeing that up-to-date information to allow you to make those decisions and to meet those deadlines.
Great. I know we're just out of time now, but do you want to cover quickly what happens if I miss an annual return?
Yeah, sure. So this is probably for the newer businesses on the call, but if you do miss an annual return, you do get a fine, and it does increase every day by about €3 a day. And it can lead to, apart from year one or the first annual return, it can lead to audits for 2 years. So, I mean, this is one of the dates that I mentioned earlier on, Joanne, really has to be in the diary. There's no excuse for it not being in the diary because it doesn't change. So you can get ahead of that as a business owner. You can expect that email then from your company secretary or for your accountant, whoever's taking care of your annual return for you.
Okay, great. I've just popped a link in there, I suppose just to get your feedback on today's webinar. I suppose it's really important to us and helps us improve on it, and also shares the information to other people as well that might be interested. And I do advise you to join or look at our events page on our website. We have a webinar coming up soon regarding tax saving strategies, and it's hosted by Tom Francis. We also have one on Friday, so it's regarding employment law, and we have that. We're partnering with HR Suite, so I'll put in a link there to our events page so that you can join any of those webinars, which are free to clients and non-clients. And here is some of our information details if you want to find out some more about our services, including company formation, company secretary, annual accounting compliance, year-end services, or bookkeeping and VAT. Do reach out to us. We'd be happy there to support you. And thank you to everyone for your participation on the webinar today, and to you, Larissa, as well, for sharing your valuable expertise and facilitating the Q&A. And a recording will be shared after the webinar today. And if you have any other follow-up questions, please do feel free to reach out. We'd be happy to support with that. So thank you, everyone, and thank you very much to you, Larissa.
Thank you, Joanne. Thank you, everyone, and have a great day.
Have a great day. Thank you.